Good day, everyone. I'm Yulli from Executive MBA Class 2023, IPMI International Business School, Jakarta. Thank you for watching thoroughly the Mind Mapping Corporate Finance class. And let me start by greeting our professor. Good morning, Prof. Roy. His morning spirit is always inspiring us during our noon class, especially for myself who has no finance background. It was really a challenging class session. With his unique class roots, it's okay to make a mistake and you are wrong with the right purpose during our hybrid class. With our weekly agenda, start with review course outline, individual and group assignment, and along the course, we were assigned for book and movie review, and last session presenting our guest lecture by CEO of PLN, Ibu Sinta Rusli, and summarizing all the course outline through mind mapping and have your own journal financial review for your own publication. At the end of this course, we were expected to be able to explain important financial management decision and interlinkage among them. Apply financial management decision-making tools in analyzing financial decision problem. Explore and evaluate opportunity to create financial value to firm and investors. Utilize logic of corporate finance to improve participants' decision in other business-related situations, and demonstrate ability to discuss in a structured way hot issue that emerge in the business or finance media. Herewith further on summary of our course of content during 7-week class session. The first one is Introduction Financial Management. The second one is Time Value of Money and Capital Budgeting. The third one, Analysis of Securities and Portfolio Investment. The fourth is Capital Structure and Corporate Restructuring, Fraud Risk Management, and Issues in Finance. The fifth one is the book review, International Finance and Dividend Policy. The sixth is Event Analysis, Portfolio Performance Evaluation. And seven, the last one, is our final examination. In the corporate finance, there is several contents that I would like to share with you, which is start from the financial management, the time value of money, capital budgeting, investment strategies, capital structure, corporate restructuring, fraud risk management, international finance, and the last one is the dividend. And what about the corporate finance? This is the objective of the course, to give the student problem-solving skills in finance from the point of view management internal and investor externals. The goal of the financial management consists of three keywords, which is optimal orchestration of internal and external financial resources towards significant and sustainable value creation. There are several resources of finance to be managed. Those elements to be managed to achieve a goal of the firm, which is not a profit, but to create a value. When the firm trying to create a value, there is often happen principal-agent problem. It happen because of two parties, the principal and the agent. For the point of view of investor, they want to get maximum benefit. However, from the point of view management, they want to work less but highly paid salary and more bonuses. Those are the conflict of interest. The asymmetry information is the information is not balanced. The management knows about the business due to they run the business day to day, while shareholder know less or limited information about the company. Moral hazard is basically management wants to get benefit from themselves. Consequences of asymmetry information and moral hazard, the management tends to report only the good things. So, the shareholders think the management is doing a well performance. The solution of the principal agent problem should be a comprehensive solution through a corporate good governance, which we call tariff. Tariff stands for from transparency, accountability, responsibility, independently, and the last one is the fairness. We also capture and learn for cornerstone of corporate finance based on McKinsey. Business value depend on who owns it, who manages it, and might be who own it. And Professor Roy has given interesting illustration of the golf stick. In the case of the golf stick, it might be an off stick if handled by the wrong person. But if we handle by, for example, a Tiger Woods as a master golf championship, it will be creating a value. In this value creation, we also capture the 5 business model from Ram Charan. Ram is the best-selling author. His books are shared around the world for their unique insight into modern business issues, essentials, cash, profit margin, velocity, growth, and the last one is customer focus. Now it's about time value of money. It's important topic to understand in finance in many ways in daily life, and there is two concept of time value of money: present value and future value. Present value is about $1 today is equal how much in the future. Future value is about $1 in the future, how much equal with $1 today. The time value of money, assuming receiving $1 in the future, into interest we could earn if we have received $1 sooner. So if we can measure this opportunity cost, we can translate $1 today into its equivalent in the future, what we call as a compounding, and translate $1 in the future into its equivalent today, what we call it as discounting. Capital budgeting. Capital budgeting is investment planning process for long-term asset. Estimated expected future cash flows. Evaluate the project based on capital budgeting evaluation criteria. Decide whether or which project is good or bad or should be rejected. 2 or more projects can be mutually exclusive, may choose only one, or independent that we may choose all good projects only. Capital budgeting consists of 4 methods: payback period, net present value, profitability index, and internal rate of return. Payback period is how many years does it take to cover the initial investment. But payback period have some weakness, which is very subjectivity, not consider time value of money, not consider required rate of return, not consider all cash flow from the project, and the last one, not considering the net present of value. However, net present value is a better way of capital budgeting because it compares money you have to sacrifice today, the benefit of project cash flow present the value compared to what you sacrifice today. ERR is a percentage average return if you have the project versus if you want to put the money in the bank. If ERR larger than required rate of return, then you could proceed the project. Investment strategies. Security analysis that we should understand before we do the investing consists of two analyses. Fundamental analysis is focusing on intrinsic value of company by examining macro and industry factors. Besides that, we need to understand the situation of the company, healthy or not, by doing rational analysis with DuPont analysis, and can be complemented with technical analysis, which can predict the movement of the price of the stock by looking at repeated chart trend to decide when the right time to buy, the right time to sell, and the right time to hold, whether this investment for short-term or long-term investment period. After we understand the investment strategies, we need to calculate the company intrinsic value. Portfolio investment is about risk and return. It starts with identifying the risk. There is two types of risk, systematic and unsystematic risk. Systematic risk, it depends on the company risk, while unsystematic risk depend on macroeconomic. Unsystematic risk can be minimized with diversification, while systematic risk is the market risk that can be eliminated. Systematic risk, also called beta. Beta indicate how volatile is the market. With diversification, we can select our portfolio with those with negative correlation, so the negative effect one and another can be cancelled, so we could get a good profit. Like an old one saying, don't put your basket in one egg. Next, we need to identify the required rate of return of our investment. We could calculate with cost of capital. Cost of capital can be calculated by using two ways: cost capital asset pricing model and cost of debt or weighted average cost of capital. Capital structure. What is capital? Capital is a long-term sources of fund. Can be from debt or equity. And what is the ideal debt to value of firm? Value of firm is present value of future flow for capital holder. Capital holder consists of debt holder and shareholders. We also learn about irrelevant capital structure by Modigliani-Miller. If all factors are ideal, then it is irrelevant. But if we change one factor not being ideal, then we can see the impact of the firm value. For the example, the tax. The higher the tax, the higher the interest rate, the lower will be the tax. The higher the debt ratio, the value of company, the higher the value of company tax shields of interest payment. If we keep increasing debt ratio, it will be in danger and the company will be in jeopardy. Corporate restructuring. We learn about how to overcome financial distress in the company. The outcome of financial distress are turned around the opportunity, or is it about not permanent problem? For example, due to the COVID, we could do operation restructuring, asset restructuring, and financial restructuring. But if it is permanent problem, we could file for legal bankruptcy. And how should we deal with this financial distress? It's about surviving and transforming the business. Some common things that we should do is stop the bleeding, financial restructuring, temporary pivoting, strategic realigning, and redefining core business. And the last one is about new ways of doing your business as well. And in the corporate restructuring, there is 8 things to manage. The first one is capital structure. It's about debt to equity ratio. The second one is working capital management, permanent versus non-permanent current assets, and it's about choice of working capital financing. The third one is asset structure, is fixed asset ratio. The fourth one is revenue management, is portion of recurring revenue. The fifth one is cost management, is about the fixed cost portion. The sixth one is cash flow management, is how the way we focus on 5 principles of cash management. The seventh one is growth management, focus on organic and partnership growth. And the last one is risk management, is on the risk appetite. In this topic, we learn about fraud triangle in the fraud risk management. There is a reason a person doing a fraud in the company due to of pressure, opportunity, and rationalization. How to prevent fraud risk if the company is by using the whistleblower mechanism. There is also 4 types of incentive for people: physically, monetary, social, and moral. International finance. We learn on foreign exchange. Allows currencies to be exchanged in order to facilitate international trade or financial transaction. Has evolved from the gold standard to agreements on fixed exchange rates to a floating rate system. Foreign exchange transaction. Market for immediate exchange is known as the spot market. Trading between banks occurs in the interbank market. Within this market, brokers sometimes act as intermediaries. Forward market enables a multinational company to lock in the exchange rates at which it will buy or sell a certain quantity of currency in a specified future date. Customers in need of foreign exchange are concerned with the quote competitiveness, special banking relationship, speed of execution, advice about current market condition, and forecasting advice. On the currency futures and open market, there is 2 options. Currency future contracts specify a standard volume of particular currency to be exchanged on a specified settlement date. They are sold on exchanges unlike forward contracts. Currency call put option give the right buy or sell a specific currency at a specific price called the strike or exercise price within a specified period of time. Dividend policy. When should a company pay a dividend? If we pay dividends, stockholders receive an immediate cash reward for investing, but the capital gain will decrease. Since this cash is not invested in the firm. There is a reason why companies should pay dividend. Number 1 is tax, but it's not about company tax. It's about the personal tax. The second one, principal agent. Too much cash flow. The company report is the real one. The third one is shareholder expectation. Create value by paying dividends consistently, and the company dividend will be there. So there will be the last session of my mind mapping of corporate finance class by Professor Roy Sambel. I'm Yulli, and again, thank you for watching.